Hello and welcome to this Helium trades tutorial. In this tutorial, I'm going to walk you through trying to understand some of the Helium charts, explain what the different charts mean and the different indicators, and then we'll use that to trade the SPY. Let's get started. First, I'm going to log into Helium Trades, and we're going to search for SPY. So now here you can see the SPY. This is State Street's S&P 500 Index Tracker ETF that we're going to be trading. So let's take a look at the chart here, and I'm going to explain what each of these lines means. So first, you can see the black line is SPY closing price. So this is every day, what is the closing price? And if you want, you can hover your mouse over it and you can see what the closing price was. So on March 29th, it closed at 282. So this blue line across the chart here, the 90% confidence interval, means that this is what the Helium model thought that the closing price would be made the day before. So if we kind of zoom in here, you can click and drag to zoom in on the charts. This is saying that on April 12th, the closing price was 290.16, and one day prior, the prediction from April 11 was saying that the Helium model thought that the closing price would be 288 with a 90% confidence interval between 290 and 286. And you can see that in this case, it was correct. So if the black line is closing within the bounds of the blue line, that means that the model was correct in its 90% confidence interval. So you can expect that if it's 90% confidence interval, about 10% of the time, the closing price is going to end outside of the confidence interval predicted by the Helium model. Now, we can zoom into the right part of the graph and look at the future forecast. Using the left arrow, we can drag to zoom in to make things a little clearer. For the future, we see two cones. One is the 90% Helium forecast. This is the green one right here. Now, what does that mean? The 90% Helium interval is Helium's 90% confidence interval forecast, the same thing that generated the blue line that you saw back here. What is this turquoise one? This is the 90% confidence interval based on options pricing. So this is saying if we look at a 90% confidence interval of future predictions for the SPY, how much uncertainty is priced into the market as reflected by options prices. And as you can see here, there is a discrepancy between these two predictions of future uncertainty of the SPY. The green price cone is Helium's future prediction of uncertainty, and the blue one is the market's prediction of future uncertainty. So how do we interpret this to make a good trade? You can see at the top of the price cones here that there isn't a big difference between the Helium forecast and the market forecast. This means that both Helium and the market are expecting a similar amount of future uncertainty to the upside. Now let's look at the downside. You can see that there's quite a difference between the uncertainty expected by the Helium model and the uncertainty expected by the market. So for November 26, 2019, the Helium model is saying that with 90% chance, the price will be above $306.46. However, the 90% confidence interval calculated from options pricings thinks that there's a 90% chance that the market will be above $302. If the Helium model is correct, this means that the puts, or the downside risk of the SPY, is overpriced, and we can sell options down here to make a profit. This means that the Helium model thinks that there's more risk priced into the market than is necessary and presents a ripe opportunity for profit. We can sell the overpriced put options down here. One good question is, how do we know that we can trust this Helium model? If the Helium model is correct, it means that these put options down here are overpriced. If the Helium model is wrong, that means that they're priced accurately and we could be entering a bad trade. How do we know that selling expensive put options down here is a profitable move? Well, the short answer is we don't know. The only reason we should expect to make any money at all is because we're taking on some type of risk. But Helium's models are very transparent about their previous performance so that you can get a holistic interpretation of how accurate this model is. So if we go up top here and look at the different tabs here, you can see that this is the performance from different time frames. So you can see 2-day, 3-day, and 4-day. Just like before, if we zoom in here, we can see that the black line is the closing price, and the blue line is the 90% confidence interval forecast made 4 days prior. So on June 21st, 2019, the SPY closing price was 294, and 4 days prior, Helium had predicted the price to be 289, with a 90% confidence interval between 295 and 283. You can see that on June 21st, the closing price was within the 90% confidence interval, and you can also see that on June 7, it was not. One way of measuring how good the model is the prediction versus actual correlation. So this is the correlation coefficient between the predictions that Helium made and the actual price movements based on the closing price in the market, where a big positive number is good and a negative number is bad. Additionally, Helium models will tell you the percent correct up or down. This is just the percent of the time that the Helium model got the direction up or down right. By looking at the price performance over different time periods, you can get a better sense of the model's strength and weaknesses. This is a useful feature for traders because it puts control back in your hands. For example, This model here has a prediction versus actual correlation of negative 0.11, 46% correct, and a 94% chance of a false correlation. Unlike analysts who just assume they're always right, now you can see the actual past performance of this model to judge whether or not you want to trust it to make your trades. And in this case, you can see that predicting the price for 1 day, 2 day, 3 day, and 4 day was not particularly good. A more general way of gauging how good this Helium model is the Helium score. Helium score is the average of all of the prediction versus actual correlation coefficients across multiple time periods, where again, a big positive number means a more accurate model at predicting the future price. So then why do we want to trade this model if it has a negative Helium score? The reason is because we want to make a trade that takes advantage of the potential mispricing of the put options in the market. By trading flexible instruments like options, we don't have to be exactly correct about the price. Instead, we can let volatility and the time decay of options work in our favor. Since the Helium model thinks that there's less downside risk than the risk priced into the market, we're going to sell expensive put options down here. It's important that we use Helium to inspire our trade while not following it directly. Helium Trades is not an oracle and merely provides an estimate of future risk in the marketplace. If you're looking for an oracle that's going to tell you exactly what's going to happen in the future with complete accuracy, unfortunately, it doesn't exist. What Helium can give you, however, is a confidence interval of future price that it expects to be correct about 90% of the time. One important detail is that the market expected future uncertainty is calculated with options expiring in about 50 days, so those are the options that we're going to trade. Additionally, the color of the 90% Helium forecast, which you can see in this case is green, means that the Helium model is slightly bullish on this stock. But keep in mind that the probability of percent up or down is not 100%. Now that we've looked at the Helium model, let's go place our trades. Now, pulling up my E-Trade, we're going to go to Trading, SPY. We have the January 20 options expiring in about 58 days. So how do we use the information that we got from Helium to actually place a profitable trade that takes advantage of the information but doesn't overly rely on the model? One potential option is a put credit spread. What does that mean? A put credit spread means that we're selling an expensive option out of the money and then buying an option even further out of the money to ensure our position. Let's take a look. On the right side of the screen here, you can see the put options, and in the middle here is the strike price. Currently, the price of SPY is $310. Now, for a credit spread, we're looking for a trade with somewhere between, I would say, about 60 to 80% chance of success, meaning that if we held this option to expiration, we would be successful about 60 to 80% of the time. The market thinks that if we sold this 304 put, that at expiration, there would be about a 66% chance of success for us. So we're going to sell the 304, and then to ensure our position, we're going to buy an option that is even further out of the money, but a cheaper option to protect our position. The closer the strike price is to the option that we sold, for example, the 303 strike, means that we have the potential to lose less money, but the initial credit that we receive will be lower. So let's sell the 300. This means that at expiration in 58 days, if the price of the SPY is above 304, then both of these options will expire worthless and we will keep our initial credit. However, if the price is below 304, we will lose money and we're insured down to $300. Let's take a look at the snapshot analysis to look at the risk profile. You can see here that the maximum profit is $170. This is what we would get if we held these options till expiration and the price of the SPY was above our short strike of 304, meaning that both of these options will expire worthless and we keep the initial credit that we got from selling an expensive option and buying a cheaper one. Now, to put this into perspective, let's do a quick back of the napkin expected value calculation. We'll do $170 with a probability of 0.87 minus $630 with a probability of 0.04 or 4%. You can see that the result is plus $122. This means that the market is telling us that if we were to conduct this trade an infinite number of times, the average expected return would be about $122. This looks good, so let's pull the trigger. Great, we got filled. Now, the next question is, how do we manage this position? One thing that we recommend at Helium is to collect our profits early. What does that mean? That means that instead of waiting for these options to expire so that we can collect our full credit to reduce our risk, we will be a little bit greedy, and once we reach about 60% of our potential profit, we will take our profits off the table and close the position. How do we do that? In E-Trade, we can click on the SPY vertical spread that we just opened and click Exit Plan. You can see here that this percent change from cost is what we want to set to about 60% of profit. Clicking this down until we get to about 60%. This means that as soon as we hit $98, we'll close this position. Let's go ahead and click Create Order, Preview, and Send. Now, a common question is, are we going to protect this trade on the downside? Meaning that if this trade goes against us, are we going to exit early? And the answer is we are not. Rather than managing this position on the downside, we will let the probabilities work themselves out and not get emotional and close this trade out early for a loss. All right, and we're back. It is December 16, 2019. You can see that we successfully closed out this position for a profit of $99.84. Now this happened automatically because we wanted to lock in our profits early at $99. Early in this position, when we opened it, this position actually moved against us. So this position was down for several weeks. So if I had been reactive, I would have potentially closed out this trade for a loss. But by actually doing nothing, we were able to turn this loser into a winning trade. Now let's donate the profits. So for this tutorial, we're going to donate to ZSL Wildlife. They're a nonprofit dedicated to protecting at-risk wildlife populations. They do a lot of nice work. If you're interested in them, definitely check out their website. You can see here this cute African wild dog, not a hyena, and a wild dog. Looks pretty mean, but pretty cute. Let's donate. Excellent. Looks like it was successful. And that's a wrap. Thank you so much for watching this tutorial. If you have any questions, comments, or feedback, post them in the comment section and I will try my best to get back to you. Thank you.